I am going to show you the most effective and accurate way to find trading entries on the 15 and the 1 minute chart. I structure all of my videos as a crawl, walk, run, so stick around until the end so that way you don't miss any steps. It's the levels that I mark off every day. It is the time that I'm trading. All of those little things, those little details that you can control are the things that are going to help you become profitable. The levels that I'm marking off are the high of London, the low of London, the high of the gap time, the low of the gap time, and then the first hour high and the first hour low. The market only does three things: breakout trend, breakout reverse, or stay inside of a trading range. So that can help me to develop a bigger thesis in my session, as well as looking at signal days, 3-day cycle, what day is it within the week. All of these things are going to help me to identify trade setups before I even get to my entry criteria. I also make sure that I'm taking note of my 100 pip boxes and looking for 3 levels of rise or fall. These are all very important things. Along with, last but not least, making sure that I have my previous day's high and previous day's low up on the screen at all times, because that is a very important level within this strategy. The entry criteria is only ever used once there is a larger trade setup in play, and once you've identified and then started to add other little details in there, you're at a certain time of day, your process has already started to play out, and now it is time for us to get to the entry. Where the entry process, right, this is my every single day piece, kind of like we just talked about on the previous slide, where I'm identifying the levels and the setup. All right, that's 1 and 2. But the next part of that is identifying whatever trade that I'm looking at. Is it with trend, or am I taking a counter trend trade? Because those are two very different ways that I'm going to enter the market, or at least target certain areas within the market. It's very different. So if it is with trend on the 15-minute chart, I would have something like this. They could be going up, and then they break structure to the downside. 3 pushes back up. On the 15-minute chart, that would create a long squeeze scenario. This could also be an instance where we're in a trend, right? So there's a break of structure. Maybe they've made a higher high and they're pulling back in 3 pushes, and I'm looking to get in over here. Both of these examples, however, are with trend because there was a trend and then now it's a lower low and we might be starting a new trend. That's totally fine. Or with trend in the sense that we've been going up and it's a trend. It's an already existing trend, and I'm just looking to basically play off of that already existing trend. Now, those are both with trend. A counter trend trade, however, would be an example where I have, let's say, a breakout level, and the market has broke out through there, and it's very, very extended. Some characteristics of this could be, we could have maybe 75, 100, 150 pips from where current price is down to that level. Now, this breakout level could be not only a breakout level, but it could be also like a swing level. So like if I had a swing low down there and I'm 150, 75 or so pips away from that level, I'm looking on the 1 minute chart and it breaks down and I get my exact same pattern that I just showed you, I could still get a counter trend trade maybe back down to one of those levels if it were to present in a certain way. And I'm going to talk about all of those different ways that it presents over here in my entry criteria, which is what we're getting to right now.
Nelly, what is that?
Yep, I agree.
So what is the criteria? The entry criteria is fairly simple. I have a level formed. Remember what I just said in the previous portion. Basically, if the market, let's say, for example, is going up and then it breaks structure to the downside on the 15-minute chart and it starts to pull back. Remember, I need 3 pushes back up. That means that I have a level formed. A high is formed. We made a lower low down here, and now we're pushing back up in 3 pushes on the 15-minute chart. Now, whenever this new extreme is formed, we made a lower low. I am automatically down on the 1 minute chart. And for example, if this was going up like this, and the moment they break structure like this and start to pull back, again, I am down on the 1 minute chart. These are both 15-minute chart examples. Whenever we get this new extreme and I go down to the 1 minute chart, this is going to put the market into an uptrend on the 1 minute chart. And we have the last leg of the 15-minute chart right here. And that would make the 1 minute chart look a little something like this. Now, I need the 1 minute chart to get into alignment with our newly found trend, right? The trend that could be starting to form. The way that I do that is I identify my swings, something like this, and then whenever on the 1 minute chart there is a break in structure, just kind of like happened over here on the 15, I now need 3 pushes back up again, a chart pattern since we're trying to get the market to go down, and then an engulfing candlestick of that chart pattern right here. That's always going to be my first entry. My stop will go above the pattern, and my target will be wherever. Now, all of that's great, but there are different types of entry. For example, all of these things that I just showed you are pattern-based entries. Those are the minimum requirements I need to basically press the button and get into a trade. However, there are other things that I'm considering, other things that I'm looking at to try and help me add confluence to the trade or entry, or really just the entry in general. And that is going to be time engulfments. A time engulfment is the opening of a candle, maybe 3 pushes, some kind of consolidation, and then they engulf that opening time back down or up, whichever way, leaving all of that volume stuck. That is one method or one thing that I'm looking for to find where traders are trapped based off of time. Another thing that I'm looking for, being trap volume, that kind of plays into the time engulfments piece. I'm looking for certain candlestick behaviors to trap volume around certain levels. 3 levels of rise using the 100 pip box, which is what we're going to talk about towards the end of this video. And really just 3 levels rise or fall using the price action as well. Those are different things, and we're going to talk about all of them in this video. This is an example of a 15-minute downtrend, and at one point, they are going to flip that downtrend around. So we're making lower lows, lower highs, and then all of a sudden, they make a higher high. Now, once they make this higher high, the moment that this candle closes and it starts to come back down, I go down to the 1 minute chart. The reason for this is because this pullback on the 15-minute chart is going to start a downtrend. It's going to start a downtrend on the 1 minute chart. And at some point, that downtrend on the 1 minute chart is going to end, and I'm going to get the rest of my criteria to play out, hopefully down here somewhere on the 1 minute chart. And that is where I can find good entries to get into this market to continue with trend, right? The continuation of that trend back up. This is the 1 minute from that previous slide of where I was showing you they were pulling back in 2 candles on the 15-minute chart, but this is what it looks like on the 1 minute chart. And you can see that this was the break in structure right over here on the 15-minute chart. And once they started to come back down, well, that started a downtrend. We have push 1, push 2, and then a third drive back down into the low, ending a 1, 2, 3. You can kind of see the larger W here. If I draw it like this is a shortened W. And then there's also a smaller pattern within the pattern over here. If I were to look at this W like this, where it's a down, up, down, and then they engulf the lower W within the larger W, and that would be my entry. Now, I can either take it off of this one here or off of this one here. Maybe I didn't notice the micro W. It's okay, either one. And then I will use 1 or 2 candles on that 1 minute chart to find where I'm going to put my stop. So if I were to take this entry here, I would put my stops maybe down over here. If I were to take this entry here, it would be 1 or 2 candles, so maybe like down over here. Because from my own back testing and from my own experience, if this is the trade, if I get in at the right time, they're not going to stop hunt anymore. It should just be a fluent price movement in a direction. Now, up until this point, we've only been looking at pattern-based entries, right? Now we're going to get into some time engulfment style of entries, where we still need the pattern engulfment or the pattern style of entry. However, we can now start to throw in other pieces into the mix to add confluence to our trade. So note the 15-minute, the 1 hour, and the 4 hour candle opens. This could be within your session, and of course, the 4 hour candle might be before your session. Observe looking for 3 push patterns after a candle has opened on the 1 minute chart. The push pattern will be observed on the 1 minute chart. Wait for price to compress within the candle open times and go into consolidation. Entry criteria still applies. Candle will engulf 1 or more of these opening times, solidifying the trap. And sometimes you'll notice that they will box in or layer on top of one another a bunch of opening times. So like if the market was coming down like this and they're opening certain times and then they go into consolidation, something like this, and then all of a sudden, boom, you get a big candle like this. And it basically has just solidified. Anybody who who sold any of the opens of these candles, which is essentially the close of the previous candle, they are now stuck in the market in theory. And that is part of the theory because, for example, if I were to get in on this candle and say, hey, they may have just solidified the trap, at least in the bottom half of this box of these open times, I could put my stop down here and feel a bit more confident about, man, they really shouldn't go back down there because if they do, I'm probably wrong. They're not actually trapped down there. They haven't actually been doing work down here, and I'm just wrong overall about my timing. So this is a great method of controlling risk and keeping a tight stop because, one, it works, and two, it gives me a really good reason for why I put my stop in a certain area. Let's look at the example that I have up here on my screen. You can see that the market was in a bit of a downtrend over here and making lower lows and lower highs. Now, observe the times. Notice that the candle behavior, as soon as this 10 o'clock candle opened, they drove aggressively further down into the low. We've got push 1. And then they drove down very aggressively, again, push 2. Notice the size of the candles. They're getting bigger within this hour. That is something to take note of. It's important. And I draw my little low across over here. I know that line's not very straight, but you can see that they went into consolidation and they drove into low one last time, and a 1, 2, 3, 10, 15 opened up right here. And then they give you a little W down low. And then engulfed that whole thing right here, and then again right there. So on this first engulfment right here, if you were to take an entry and you were to say, hey, I'm going to put my stop down here, 1 or 2 candles, and then they did this, right? Maybe this is an opportunity to add into your position with stops just below something like this because, hey, you know, maybe they're stuck under 10.15. That could be the idea. Maybe I'm going to move this stop up a little bit because they should be stuck under 10.15. And then, hey, they engulfed 10 o'clock. Maybe I'm going to add in some more so I could scale in. And I'm going to put my stop again underneath 10.15. And as they continue, I should feel comfortable with moving my stops up and acknowledging that maybe we have volume trapped underneath 10 o'clock. It could be like a huge box of volume down here where they're allowed to retest it, but they shouldn't be going deep down into it, kind of like the idea of trap volume, right? They can retest it, but a lot of times I don't want to see them go super deep down into it. This is a great way of, like I said, managing risk, also figuring out where people are stuck in the market and see where they're inducing people on the 1-minute chart to take entries, because if they're inducing people to go short, and I have a long idea or a long trade thesis setup, you know, maybe it's a first green day or something like that, that is, again, extra confluence to my trade. In combination with the time engulfment method, as well as, of course, the pattern engulfment minimum, you have to look at who is trapped in the market. And this is a list of patterns that I search for to search and see who is stuck and where. The idea behind all of these patterns is that the market moves in threes. And if the market is moving in threes and there's a second push, right? This is what gets everybody to start entering the market. It's happened once, it's happened twice. Okay, from now, if it's happened twice, maybe I'm going to enter in looking for that third, basically looking for the trend trade, right? This is what everyone's taught to do. It's happened once, it's happened twice. It's probably going to happen again. I'm going to enter in and I'm going to go long. Now, yes, it goes up, but it won't usually put people so far into profit that they're willing to take profit. That's the key. They have bought the close of the second candle and the market continues, but they're not taking profits up here. All right. This is just an area where, hey, it's continued and it looks good. And then all of a sudden it does something like this. Now all of these people above that second push are trapped. And that's the behavior that I'm searching for. 1 push, 2 push, look above the second push over here for that trap using one of these patterns, which you can find in the link to that video that I had in the previous slide, and it explains all of these patterns. Over here in this example that we see right here, this is not coincidence. All right, the market is always trying to get you to do something, whether you realize it or not. Candlestick size, candlestick, the speed that the candle is moving. And then notice the candles all of a sudden getting much larger. 1 push, then you have a second push, and then all of a sudden you have a third push, and it just doesn't go anywhere, right? It goes up, big, strong candles, and then it just stops and reverses very aggressively back the other way, collecting all of this order flow on the way down. The 100 pip box can give you not only an area of the chart where people are getting trapped, but it also gives you a way to measure strike zones so that you can look in certain areas of the charts to find more accurate trading entries. The 100 pip box is comprised of a double zeros, and then 25 pip increments in the middle. So you have 25, 50, and then 75 up here. And this is simply the price, all right? It's the price of whatever you're looking at. So if I have a market that is $100, and then up here would be $101, that is 100 pip increments. And then this would be like $100.25, $100.50, and then $100.75. Again, being 25 pip increments from there to there. How do I measure strike zones? Well, there's a couple different ways because there's a couple different things that you need to identify first. Number one is, where is my consolidation? Because this is what I'm going to consider a ground level, all right? In this example down here, notice that we have double zeros and double zeros here and here. They've been consolidating inside of that box. All of the price movement, all of the price trading has been inside of that box. And they have failed multiple times to break out of that box, and eventually it succeeds. What does that tell me? Well, number one, this tells me that this could be a ground level, because from there, I need to then measure up 3 additional levels. How do I know which kind of 3 levels to basically measure, right? Because it could be measured in 3 levels of 25. It could be measured in levels of 50. How do I know which one to use? Well, I use the ground level. How big was the ground level consolidation? In this instance, it was 100 pips. So I'm going to measure up 3 levels of 100 to give myself a potential strike zone for that market. And you can see here that this did go up the 3 levels, and then they came out 25 to 50 pips outside of the box is the average stop hunt zone. What this does is it gets people to start going long or short, whichever direction the market was going. It also, anybody who's maybe short up in this level, they go 25 to 50 pips outside of that range to get people stops or whatever it may be. This is it's basically like a bank trading method. These are bank levels. Areas of the chart where price reacts, and you can tell that there is some kind of larger institutional trading going on in these areas. The idea is that price is always in a box, and the market only does 3 things. It's either going to stay in a trading range, it's going to break out and fail and go to the other side of the range, or it'll break out and begin to trend. That is the whole premise behind this style of trading, and it works very well. So kind of the practical application portion of this, and you can see it over here, I'm going to identify a consolidation within a 25 to 100 pip box. It should be obvious. If they're consolidating in a 25 pip box, you're going to see it because they're going to be trying to come out of that box multiple times, and it's failing and just staying inside of that box and then eventually succeeding eventually, right? Whichever direction they come out of the box and they begin to climb, now I know, hey, like I was in a 25 pip box. That was my ground level. Time to measure up 25, 25, and 25. And that is how I identify potential strike zones, as I just dictated down over here. Now, in the previous slide, I showed you that there is always going to be some kind of ground level that you're searching for. This is a second practical application style, measuring down from, let's say, the current or previous day's high or previous day's low level. So, for example, the day was up here, or previous day's high was up here, right? So this is measuring down from the previous day's high as well as the high of day. But we started up here in this 25 pip box. So this is my ground level. Then I'm going to measure down 3 levels of 25 because we were in a 25 pip box when the day started up here. You can see that they were holding price in that box for a while, and then they came out of it. And it came down level 1, level 2, level 3, a little bit outside of that box, totally normal. And then you're looking for that trade from the low of the day. That is a 3 levels of drop trade setup. There was the low down here. We had a high up here. So they've traded down 3 levels down into a swing low. You know, we're in a trend. They've made a higher high. Once they make a higher high, what did I say about my entry criteria? I'm looking for those 3 pushes back down. So this is just another way that you can add confluence to your trade. Down here at the low, you're looking, you can see maybe on the 1-minute chart, time engulfments. The entry criteria start to play out, all of these different things. However, this is a fantastic way to find strike zones in addition to those other methods. And now to come full circle, we have combining everything together. A little bit hectic, but I'm going to show you exactly what I'm talking about. We have the 15-minute chart over here. We have a break in structure to the upside over here. So if they've made a higher high, which means that I'm already down on that 1 minute chart when the day begins, but I have to do my analysis, right? So at the end of the day, I complete my process of analyzing. We had the high of day from Monday. We had a low in place down over here that was not quite going higher. So that means that my low was actually down over here. Then I can measure from the previous day's high down 3 levels, push 1, push 2, push 3, whatever it may be. When the day starts, same process every day, marking off the high and low of London, high and low of the gap, and then looking and seeing where is the consolidation at the start of the day. Well, there was a consolidation in that 25 pip box, giving me 3 levels or 3 boxes of 25 down for potential strike zone. I already have a potential strike zone because of that low that was down there, but now I have even more confluence to the trade. Once I come to the screen, I have the low of the gap time in place down over here, and they go lower in my session. But I'm in that level 3 of the 100 pip box or the 25 pip boxes measurements down. Over here on the 1 minute chart, notice level 3, they blow off down into the direction of the trend at the beginning of the session. 8 o'clock opens up right there. And then from there, they trade down, give you a little W down here, spike up, spike back down. Now we have an extended W down low, breaks out. Notice the candle that goes vertical through that opening time. Notice that they never go down back below that. That is what I'm referring to when I'm talking about time engulfments. Now, once they go up in the second hour of this session, right here, dictated by that 9 o'clock time, I'm only looking to take trades in that second hour. So I would have had to wait through all of this and see. So now I have my high and low of the session after observing all of these other details. Break of structure. We're now in a trend. They made a higher high. Notice the 1, 2, 3 back down. The 1, 2, 3 back down. A little W engulfment down over here. And that gives me the opportunity to now enter this market after 9:30. After 9:30, they engulf the 9:30 time as well and continue that trend up. All of these things coming out of level 3, back up into level 2. We're not back up into level 1 yet. And that gives me an opportunity for a 25 to maybe 50 pip back up into ground level style of trade, or back through the previous day's high, which is in this example here, what you see can happen, or what happened in this instance here. So all of these details come round circle together. They all work in unison, and you can use all of them at the same time to really increase the accuracy of your trades and make it more 90-10 in your favor and a bit more, with edge, instead of just trading direction or trading all over the chart. Ladies and gentlemen, I really hope you got something out of this video. If you did, hit that like button, subscribe to the channel if you haven't already, and enjoy the rest of your day.